Hello, everybody. Steve Olson here with the Peak Group, and I've got Corben from our main office there in Dallas, Fort Worth with me today. Corben, how's it going this morning?
Good morning, Steve. It's going well.
Good. Now, Corben doesn't usually get on stage. Corben is one of our behind the scenes key team members. He's our financial analyst, runs a lot of the numbers. Whenever we need to do due diligence on a project, we dump a whole stack of stuff on top of Corben, and he's a good sport. But he distills all that, does a bunch of the online research, builds out the financial models and everything. And so a few weeks ago, we were having a meeting about some of the upcoming projects in Birmingham, and we were really discussing a lot of the BRRRR, the concierge BRRRR program. If you don't know what that is, just check it out on the front page of our site. And Corben just started kind of casually taking us through some of his findings about some of the statistics and data that he had uncovered in the market research. And when he was done, we said, Corben, this is really good. People need to hear about this. Like I said, he's not typically working with the clients. He's working with the leadership team in Dallas. But he agreed, and we appreciate that, to record with me this morning and show you the findings. And before I, kind of send him off and running here, a big reason why we wanted to do this is we've been stressing a lot lately about the multidimensional benefits of investing in real estate because the market right now is not in equilibrium. It's quite confused. There's a bit of a standoff between buyer and seller. They're both expecting a little bit more than what is given right now, and many times you have to go. I've been saying lately, go on offense, and you have to say, well, is it just about cash flow? If I sit around waiting for this cash flow, will I still be waiting in 2 or 3 years? Um, we don't know the answer to that question. And therein lies the crux of Corben's presentation. He is going to show us what happened to values, property values in Birmingham over the last, I can't remember if he went to 7 or 10 years. He'll cover that. And how can we see what happened to the value of our assets? So we of course we love cash flow. Let's look at appreciation, which you don't necessarily want to bank on, but Corben also did a sensitivity analysis. And what if you bought a property in Birmingham today and it only grew by X, or it only grew by Y, or it only grew by Z? And we're going to see these various scenarios that could happen. It's my attempt to encourage you to stop trying to time the market, instead get in the market and let it do its work. So Corben, thank you again. Would you mind starting to take us through your slides here, the background on the data and what you found out?
Sure thing. Thank you for that introduction, Steve.
Yeah.
Happy to jump into it together. So this graphic is showing the Zillow Home Value Index, which represents the typical value for single-family homes in the 35th to 65th percentile of a given MSA. In this case, we're looking at Birmingham specifically. And the period we're looking at is from 2007 to 2025, so 18 years of price appreciation in this market. And I specifically called out the values from 2007, 2012, and 2025 to show how Birmingham's single-family market has experienced steady growth despite the shocks in 2008, resulting in an erosion of significant values, followed by the market shock in 2020 and a post-pandemic plateau thereafter, which to me shows resilience in Birmingham's market in the face of significant market shocks like these.
Yeah.
When I put together this information about how Birmingham single-family homes have grown in value over the last 18 years, I wanted to apply it to an example so that we could see how a typical investor might have performed in the average deal versus applying the BRRRR method. So here we're comparing the average deal from 2007 against the BRRRR method in 2007. And if you were to acquire the average home in 2007 at the measured Zillow Home Value Index, and you held it until 2025, that would have likely yielded well, given an over 3x equity multiple and an annualized equity return of about 7%. In contrast, purchasing through the BRRRR method would yield a roughly 80% discount to the Zillow Home Value Index with renovation and closing costs included. And this would have likely yielded better than the average deal, primarily because the lower initial cash payment of about $20,000 versus $25,000. This creates potential for higher equity returns down the line. And after we ran this comparison, we were curious, what might we be able to expect from the BRRRR strategy moving forward, given that over the last 18 years, it performed quite strong. These are 3 different growth scenarios projected out over 7 years, and they give us a range of expectations for scaling. The first is historical growth, which projects optimistic future price increases that are equal to the past performance from 2007 to 2025. The second growth scenario is the moderate growth scenario, which accounts for potential headwinds and tailwinds in the market. And the third growth scenario is the likely scenario, which is conservative but realistic and assumes slow but positive growth. After putting together these 3 scenarios, the question that came to mind was, how might the BRRRR strategy perform under each of these scenarios over the next 7 years compared to the last 18? So we took a look at how far an initial outlay of $250,000 could have gone from 2007 to 2025 with BRRRR, and we compared that to how far an initial outlay of $250,000 could go today with BRRRR. And we ran the numbers, and in 2007, an initial outlay of $250,000 could have likely turned into about 12 BRRRR deals. And today, with higher prices, that same $250,000 may only fund about 7 BRRRR deals. However, higher rents today versus historically improve our expected ongoing cash flow. And as we saw previously, even conservative price appreciation can lead to strong equity growth. The BRRRR strategy still outperforms traditional investing because of the upfront discount and options later on for capital recycling. And what we found here is that even in a volatile market with uncertainty, BRRRR continues to be a powerful tool to scale a portfolio and generate strong returns. And even with fewer deals being possible today with the same initial outlay, BRRRR still maximizes long-term wealth creation and is a framework that has historically worked. It continues to work, and we expect it to keep working as long as we follow the fundamentals. And my hope is that the team and investors are able to see that $250,000 invested in BRRRR 20 years ago would have been a fantastic deal. And the next best time to invest in BRRRR is today.
Yeah. I have a question, Corbin, if you would indulge me, just for clarity's sake. These returns are all calculated based on our initial cash invested into the deal. I'm assuming you've arrived at that figure by adding the acquisition price plus the renovation cost and taking 20% of that and then adding on closing costs. Is that how you got there, or was it a different way?
Yes, that's correct. To calculate that initial equity need per deal, we took a look at what the cost of acquisition on our side would be. We added in projected renovation costs to bring the property up to market standard. And we also included closing costs in
Great.
that total purchase price.
And could you just give me your rationale as well? Down in the bottom right corner, you've got your historical, moderate, and likely scenarios. What was your rationale for the likely scenario?
Sure. The rationale for the likely scenario was to give investors and the team a sense of how resilient this product and this market could be, even in the face of pretty intense volatility and market uncertainty. Nobody has a crystal ball to predict exactly what is going to happen 5 to 10 years in the future, but we can make some assumptions around volatility and expected chaos, quite frankly, in the market over the next foreseeable future. And that likely growth represents the most risk-adjusted perspective that I was able to glean from the publicly available data that I was able to find.
I got you. So, for all my fellow dumb people listening, then, is it fair to say you could just assume that the past indicates future results, but every financial advisor is always very careful to disclaim that it does not. So your likely scenario here, you're just attempting to account for, it's inevitable that we're going to have a black swan event or two of some kind, and that could, you know, punch the market down, but it will recover over time like it did in the past chart. Is that a fair summary?
Absolutely. I would say that while the future is uncertain, we do believe in the market here in Birmingham. And my hope is that the rest of this presentation has demonstrated that the Birmingham MSA is resilient in the face of market shock. And even with building in the likelihood for, like you mentioned, a black swan event or two, there is still potential to create lasting and strong equity returns through the BRRRR strategy.
That's very good. Do you have any more slides to share with us today?
This is all I prepared today.
I
I'd be
like it.
happy to
No, this is
prepare more.
we need you to do this for Dallas Fort Worth now. We want to see that too. So, but no, this is great, everybody, and I want to thank Corben for his time. Once again, this has been an effort to do a deep dive on one of the multidimensional benefits of investing in real estate. If you recall from an episode we did recently, we said real estate is ideal, IDEAL, you generate income, depreciation, equity from your tenant paying down your loan principal, and appreciation and leverage. And this one is just focused specifically on appreciation because the income component is a little tougher right now, but I would imagine too, with that 7-year hold, Corbin, tell me if you agree, you're going to see moderate rent increases along the way. And so that income component of this is only going to improve as you hold the asset. Is that a fair statement?
Absolutely.
That's the magic of 30-year fixed rate debt. And as far as I know, we're the only country in the world that has it, or at least has it on a mass scale. So, well, hey, thanks again, Corbin. I appreciate your time today.
Thank you, Steve.
All right, catch you later.